This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 16, 2026, and this is the London session. Now, let's get into it. The dollar is flexing. With the Fear and Greed Index at a fearful 14, investors are fleeing risk assets and piling into the greenback. But here is the paradox. Gold, the ultimate safe haven, is sliding nearly 2% despite escalating military strikes on Iran. And in Japan, the Bank of Japan is staring down a currency crisis as the dollar-yen holds near multi-week highs. Today, we dissect the mechanics of this safe haven failure and the central bank wars driving it. Let's look at your economic calendar. The headline event today is the European Central Bank's rate decision. That lands at 2 p.m. Eastern. This is a high-impact release that could shift the entire Eurozone policy trajectory. Also on the docket, U.S. retail sales and weekly jobless claims, both at 8 a.m. Eastern. And for those tracking the economy in real time, the GDP Now estimate is being updated throughout the day. We will watch how these data points interact with the broader risk-off sentiment. Here is the market snapshot as we head into the afternoon session. The U.S. dollar index is strengthening, with the trade-weighted broad dollar down just 0.5% on the week, but showing intraday resilience. Euro-dollar is trading at 1.1466, hovering just below its 5-day high of 1.1483. Cable is at 1.3533. The big mover is dollar-yen, which is up fractionally to 162.099, holding near its 5-day high of 162.488. Meanwhile, spot gold has pulled back to $4,034.90, down roughly 0.5% on the day, despite the geopolitical noise. Let's get into the headlines driving this action. First, Fed Vice Chair Jefferson has stated that policy is well positioned, but hinted a rate hike is possible if inflation remains sticky. Second, headlines are reporting that decades-long structural bull markets are turning bearish due to deficits and AI-driven borrowing. And third, gold is sliding despite Middle East tensions, as the stronger dollar and rate hike bets overpower the safe haven narrative. Pulse. Let's start with the Fed. Jefferson's comments suggest a hawkish pivot. How does that change the macro backdrop? It changes the entire trajectory. The market is currently pricing in a restrictive stance, with the Fed funds rate sitting at 3.63%. But Jefferson's comment about a potential hike if inflation stays sticky is a massive shift in rhetoric. We are seeing CPI at 3.46% and core PCE at 3.41%, both well above the Fed's 2% target. When you combine sticky inflation with a strong labor market, non-farm payrolls were up 57,000 in June, and the unemployment rate is a healthy 4.2%. The Fed has room to keep rates higher for longer or even hike. That creates a structural tailwind for the U.S. dollar. The yield curve, currently flat at plus 41 basis points between the 2-year and 10-year, reflects this caution. The macro setup is unequivocally dollar positive. SPECTER, you're the contrarian auditor. Everyone is buying the dollar because of Jefferson's comments. What is the risk here? What is the market ignoring?
The market is ignoring the velocity of the move. The VIX closed at 16.50 yesterday, which is relatively calm, but the underlying stress is in the correlations. Look at the SPY-VIX correlation, it's showing stress signals. The market is pricing in a higher for longer scenario, but if the labor market cracks, that flat yield curve could invert rapidly, which historically precedes a recessionary trade. Right now, the dollar is being bought on strength, but if the soft landing narrative cracks, the dollar could sell off just as fast as it's rising. The risk is that we are front-running a recession, and once the data turns, the dollar squeeze will be violent.
Let's move to our first priority ticker, dollar-yen. It's trading at 162.099. We are seeing the dollar push higher, but the yen is holding relatively firm against the euro. Grid, what does the chart tell us about the sustainability of this move at these levels?
The structure is tight. Dollar-yen is trading at 162.099, right in the middle of its 5-day range of 161.605 to 162.488. We are not at a breakout, we are testing the upper boundary of a consolidation block. The price action shows rejection at 162.488 on Tuesday, and we have failed to close above it since. The 50-period moving average is trending flat. If we see a daily close below 161.6, we break the short-term uptrend structure. But right now, the chart is telling me we are in a coiling phase, not a breakout. The momentum is fading, not accelerating.
The positioning tells a different story than the chart. In the CFTC Commitments of Traders data from July 7th, leveraged funds are strongly bullish on the yen, meaning they are short dollar yen, with a net position that has seen massive changes. Wait, let me correct that. Leveraged funds are strongly bullish on the yen currency. No, in COT terms for dollar yen, bullish usually refers to the base currency or the pair direction. Let's look at the specifics. Leveraged funds have a net position change of plus 91,779 contracts week over week. That is a massive shift. They are piling into long yen positions, short dollar yen. This suggests that smart money is heavily hedging against the dollar rally. They are shorting the very move that retail traders are chasing. When you have that much positioning against the current price action, a squeeze is likely. The chart looks like a consolidation, but the flow data suggests a violent short-covering rally is brewing if the Fed dovishly surprises, or a continued grind if the hawkishness holds.
Apex tie that together. Grid sees a coil, CIPHER sees a positioning trap. What is the strategic read on dollar yen?
The data is conflicting, which is dangerous. Grid technical structure suggests we are range-bound, capping upside at 162.488, but CIPHER flow data shows leveraged funds are aggressively shorting the dollar here. This creates a fragility. If the Fed sticks to Jefferson's hawkish script, those levered shorts will get crushed, forcing a cover and pushing dollar yen toward the highs. But if the data, like today's retail sales, comes in weak, that positioning becomes a liability. The strategic read is that dollar yen is a binary event right now. It is not a trend trade. It is a volatility play on the Fed's next move.
Let's shift to our second priority, gold. Gold is at $4,034.90. The headline says it's sliding nearly 2% despite Iran strikes. SPECTER, you called this a safe haven failure. Walk us through the mechanics. Why is gold falling when the world is at war?
It's the real yield and the dollar dominance. Gold yields nothing. When the Fed signals higher rates, real yields rise, which is toxic for gold. But more importantly, look at the COT data. Commercial hedgers are at the 100th percentile bullish on gold. They are buying the dips, but leveraged funds. The data doesn't show a massive long position in speculative accounts for gold right now. The market is selling gold into strength because the dollar is rising faster than the geopolitical risk premium. The safe haven bid is being overwhelmed by the higher rate bid. The risk here is that gold is trapped. If the dollar peaks, gold could snap back, but if the dollar continues to strengthen on hawkish Fed news, gold has no floor. We are seeing a classic sell the rumor, buy the fact reversal, but the fact, the rate hike, hasn't happened yet. The market is pricing it in.
I agree with the rate argument. The CPI is at 3.46%. That is the killer for gold. Gold is a hedge against inflation, but it is a victim of the policy response to inflation. If the Fed hikes, the opportunity cost of holding gold rises. The only reason gold is even holding 4,000 is the geopolitical risk. But as CIPHER noted, the positioning is crowded. If the U.S. military confirms further strikes, we might see a brief spike, but the structural headwind from the Fed is too strong. The macro environment is simply not supportive of a sustained gold rally unless the dollar breaks. Grid, does the technicals support a bounce, or is this a breakdown?
Technically, 4,034 is a critical level. The 5-day low was 3,983.56. We are currently sitting above that low, but we are well below the 5-day high of 4,111.96. The price action from Tuesday's open at 4,058 to today's close at 4,034 is a bearish engulfing candle on the intraday chart. We broke below the previous day's low. If we lose 3,983, the next structural support is the 200-day moving average, which isn't in my immediate data set, but historically that's the line in the sand. For now, the chart is bearish. We are making lower lows. The momentum is down.
Our third ticker, euro dollar. It's at 1.1466, approaching the 5-day high of 1.1483. The ECB decision is at 2 p.m. Eastern. Grid, is this a breakout setup?
It's a test of the upper boundary. The 5-day high is 1.1483. We are at 1.1466. We are 50 pips away from a breakout. The volume on the last 3 days has been declining, which suggests the buyers are exhausting. If we break above 1.1483, the next resistance is psychological at 1.15. But if we reject here, we could see a pullback to the mid-range of 1.1420. The structure is neutral or bullish, but it requires a catalyst. The ECB decision is that catalyst.
The COT data for the euro shows leveraged funds are strongly bullish, with a net position of plus 1,696 contracts and a week-over-week change of plus 2,164. That is a massive accumulation of longs. Asset managers are net short at minus 3,665. This is a classic levered fund-driven rally. Smart money asset managers is selling into the strength, while leveraged funds are buying. This makes the move fragile. If the ECB cuts rates or signals dovishness, those levered longs could get stopped out. The flow data suggests this rally is speculative, not fundamental. A break above 1.1483 would be a short squeeze, not a trend reversal.
Pulse, the ECB decision. What is the market expecting, and how does that impact the euro? The market is expecting a hold or a slight dovish shift. The Eurozone economy is stagnant. The ECB is likely to maintain restrictive policy to fight inflation, but they are cautious about growth. If they come out dovish, it reinforces the CIPHER view. The levered longs get squeezed and euro-dollar falls. If they come out hawkish, it might support the price, but the Fed is already hawkish. The relative hawkishness is the key. Right now, the Fed is talking about hikes, while the ECB is talking about growth concerns. That divergence favors the dollar. I see euro-dollar as vulnerable to a pullback, unless the ECB surprises with a hawkish tone, which is unlikely given the economic data. Let's move to our final ticker, Aussie Yen. This is the carry trade barometer. It's at 113.474. Risk sentiment is fearful, 14 over 100. SPECTER, what does this tell you about the risk-off trade?
It tells me the carry trade is dead. Aussie yen is a classic carry trade. Borrow cheap yen, buy high-yielding Aussie. But with the Fed hiking and the BOJ potentially intervening, the funding cost is rising. The fear and greed index is at 14. Investors are fleeing risk. Aussie is a risk currency. Yen is a safe haven. In this environment, you sell Aussie yen. The data shows leveraged funds are strongly bullish on the Aussie, but that's a trap. They are long the wrong side of the macro trend. The risk-off flow is crushing Aussie yen. I would be looking for shorts here, not longs.
Grid, does the chart support a short?
Aussie yen is at 113.474. The 5-day ranges from roughly 111 to 114 based on the Aussie and yen extremes. We are near the middle. The Aussie dollar is at 0.7000, which is a round number support. The dollar yen is strong. The combination of weak Aussie and strong yen suggests downside risk. The chart shows a descending channel. If we break below 112, we see accelerated selling. The structure is bearish. I'm watching 112 as support. A break below that confirms the trend.
The COT data for Aussie shows leveraged funds are strongly bullish, net plus 29,683 contracts, but the asset managers are net short at minus 37,303. Again, the smart money is short. The leveraged funds are chasing the rally, but the institutional flow is net short. This confirms the SPECTER view. The carry trade is unwinding. The positioning is crowded on the long side, which means any negative shock to risk sentiment will cause a cascade of selling. The flow data supports a short Aussie yen.
Apex, final synthesis on Aussie yen.
The consensus is broken. Pulse and SPECTER agree that the macro is bearish for Aussie yen. Grid confirms the technical structure is weak. CIPHER shows that while leveraged funds are long, smart money is short, creating a potential squeeze on the longs. The setup is for a decline. The risk is the BOJ intervention, which could cause a spike, but the trend is down. We are looking at a continuation of the risk-off trade.
We are moving to our weekly outlook. Each analyst gives their call for Friday's close.
The macro data is clear. Fed hawkishness, sticky inflation, strong dollar.
My call, dollar-yen bearish, target 160.5 by Friday. I expect the dollar to weaken as the market digests the lack of immediate rate hike confirmation, or as the yield curve steepens, providing relief to the yen. Wait, no, Jefferson said hikes are possible. I'll adjust. My call, dollar-yen bullish, target 163 by Friday. The hawkish Fed narrative is too strong to ignore. The dollar will push higher.
Technically, dollar-yen is at 162.099. The 5-day high is 162.488. I see a breakout above 162.5 as likely if the Fed rhetoric holds. My call, dollar-yen bullish, target 163.2 by Friday. We break the range and extend the move.
The COT data shows leveraged funds are shorting dollar-yen heavily. If the Fed doesn't hike immediately, they will get crushed. But if they do, the price moves up. Given Jefferson's comments, I expect the price to move up. My call, dollar-yen bullish, target 162.8 by Friday. The positioning will force a cover.
The VIX is low, but the stress is high. The risk is a sudden dovish surprise from the Fed or a data miss. That would cause a massive rally in yen. My call, dollar-yen bearish, target 160 by Friday. I expect the market to fade the hawkish rhetoric once the data comes in. The dollar is overextended.
Grid sees a breakout, CIPHER sees a squeeze, SPECTER sees a fade, Pulse is split. The consensus is bullish on the dollar, but the positioning is short. This suggests a grind higher, not a spike. My call, dollar-yen neutral, target 162 by Friday. We stay in the range. The data is too conflicting for a clear trend.
On gold. Hawkish Fed, strong dollar. My call, gold bearish, target 3,950 by Friday. Gold will fall as real yields rise.
Breaking below 4,000 is likely. My call, gold bearish, target 3,980 by Friday. We test the 5-day low.
Commercials are bullish, but leveraged funds are weak. The smart money is buying, but the price is falling. This is a divergence. My call, gold neutral, target 4,020 by Friday. I expect a consolidation as the smart money accumulates.
Gold is a safe haven. Geopolitical risk is high. My call, gold bullish, target 4,100 by Friday. The market is wrong. Gold will rebound as the dollar cracks.
Pulse and grid are bearish. CIPHER is neutral, SPECTER is bullish. The macro favors bearish, but the geopolitical risk favors bullish. I will side with the macro. My call, gold bearish, target 3,990 by Friday. The dollar is too strong.
On euro dollar. ECB dovish, Fed hawkish. My call, euro dollar bearish, target 1.14 by Friday.
Testing 1.1483. If it breaks, we go higher. My call, euro dollar bullish, target 1.152 by Friday.
Leveraged funds are long.
That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the New York pre-market, where we will see how these calls play out. Until then, trade safe.